Welcome to The Explainer. Today, we're going to break down a financial product you've probably heard thrown around, but maybe you're not totally sure what it is. We're talking about the fixed annuity. All right, let's just jump right in with a question that so many of us are wrestling with right now. How in the world do you get your money to grow safely? You look at a bank account and get next to nothing, but then you look at the stock market and it just feels, well, way too risky. And that feeling, that dilemma, brings us right to our first topic, the search for safety. It really is a classic catch-22, isn't it? On one side, you've got the stock market. Sure, there's potential for big growth, but there's also the very real risk of big losses. And on the other side, well, you've got your so-called safe options like savings accounts and CDs. The problem is, they often pay so little that they can't even keep up with inflation. And what does that mean? It means your money is actually losing its buying power day by day. So you're stuck between a rock and a hard place. But what if there was a middle ground? A product that was literally designed for this exact problem? Well, let's meet the fixed annuity. Okay, so what is this thing? At its heart, a fixed annuity is just a simple deal you make with an insurance company. You give them a chunk of money, and in return, they contractually guarantee to pay you a specific interest rate for a set amount of time. It's all about predictable growth. But it's really important to know there are a couple of different flavors of these. And this distinction is super important. So you've got your traditional fixed annuities where the rate can actually change after the first year. But honestly, when most people talk about fixed annuities these days, what they're really talking about is something called a MYGA. That's a multi-year guaranteed annuity. And just like the name says, a MYGA locks in your interest rate for the entire term. No changes, no surprises. It's that absolute certainty that a lot of savers are searching for. Okay, so now that we know what a MYGA is, how does it really stack up against the other safe money options you already know, like CDs or bonds? Let's put them side by side and see what we find. All right, let's really dig in here and compare them feature for feature. So, right off the bat, you can see that MYGAs often come with higher interest rates. But look at that second line, taxation. That's the real game changer. See, with a CD or a bond, you have to pay taxes on the interest you earn every single year. But with an annuity, that growth is tax deferred. That means your interest earns interest, and that whole snowball of money gets to grow bigger and faster without the taxman taking a slice every year. You only pay taxes way down the road when you actually take the money out. So you're probably asking, okay, how can they do that? How can they offer higher rates? Well, it really boils down to how their business works. Insurance companies don't have all the overhead of a typical bank. No branches on every corner, no tellers. Plus, they can invest their money in longer-term, higher-yielding bonds than banks can. And a piece of that extra return, they pass it along to you. Okay, let's switch gears and talk about safety. This is a big one. We're all conditioned to think FDIC insured when we think of safe money, right? But check this out. Since 2001, there have been 570 bank failures in the U.S. Now, compare that to this. Over the last 25 years, only 11 insurance companies that issue annuities were liquidated. So while annuities aren't FDIC insured, they have a different and very robust safety net. First, they're backed by the insurance companies themselves, which are heavily regulated and have to keep massive amounts of money in reserve. And then on top of that, there's another layer of protection from state guarantee associations. The bottom line is, historically, it's been an incredibly strong system for keeping people's money safe. All right, now, like with any financial product, the devil's in the details, right? So let's pull out the magnifying glass and really understand the fine print. One of the biggest myths about annuities is that your money is just locked away and you can't touch it. But that's not really true for most modern contracts. They usually have built-in ways to get to your cash. For example, you can almost always take out up to 10% each year, penalty-free. And many have waivers for really serious life events, like if you need to go into a nursing home or get a terminal diagnosis. Okay, now here's a piece of jargon you might see, an MVA, or market value adjustment. And this is so important to understand. An MVA only matters if you decide to take out more money than your penalty-free amount before your term is up. If you just hold the contract until it matures, or if you stick to those free withdrawals we just talked about, the MVA has zero effect on you. None. So how does this MVA thing actually work if it does come into play? Well, it's all about what's happened with interest rates out in the world since you bought your contract. It's basically a trade-off. Here's how it works. If interest rates everywhere else have gone up since you started, an MVA might reduce the amount you get if you make a big early withdrawal. But if rates have gone down, the MVA could actually increase your payout. It's a bit of a seesaw. And the reason this feature exists at all is because you're sharing a little bit of that interest rate risk with the insurer. In exchange for that, they can often give you a better guaranteed rate right from the start. Now, if you're still thinking, I'm just not sure about tying up my money, there's a really smart strategy people use called laddering. Instead of putting, say, $100,000 into one 5-year contract, you could split it up. You might put some in a 3-year, some in a 4-year, and some in a 5-year. What this does is it gives you a chunk of money that becomes available every single year. It creates this steady flow of cash and gives you total flexibility to reinvest at whatever the current rates are. Okay, we've covered a lot. We've talked about what they are, how they stack up against CDs, and we've gone through the fine print. So now we get to the most important question of all. Is a fixed annuity actually right for you? Well, let's break it down. A fixed annuity is probably a great fit if these things sound like you. You put protecting your principal above everything else. You want growth that's predictable and guaranteed. You're looking for a tax-deferred alternative to CDs, and you're saving for retirement on a clear timeline. If you're nodding your head to those, this could be a really powerful tool for you. But, and this is just as important, it's definitely not for everyone. You should probably look elsewhere if you think you might need to access all of your money on short notice, or if you're really trying to get those high stock market level returns and you're okay with the risk that comes with it. If that's you, a fixed annuity probably isn't the right tool for the job. When it comes right down to it, the whole thing is about one core trade-off. With a fixed annuity, you're giving up a bit of liquidity. And in exchange for that, you get something powerful, an ironclad guarantee that your principal is safe and that your rate of return is locked in. And that really is the question you have to ask yourself when you look at your own savings. What is more important to you? Is it the chance for higher growth, or is it the guarantee of no loss? There's no one right answer for everybody, but figuring out your answer, well, that's the key to building a financial plan that actually lets you sleep soundly at night.